When helping my clients move out of the UK and exit the UK tax system and potentially relocate to Dubai, one of the questions that comes very often is the tax year treatment. The clients mostly have this idea that the tax year is ending very soon, so they have to conclude their matters and move out of UK and move to Dubai before the tax year has ended. Or if the tax year has recently ended, then the idea comes that, okay, now I'm in the new tax year, so I will be planning for my exit in the next year once this tax year is finished. While it definitely is a prudent strategy to put your exit when your tax year has ended and on the dot, but there is also a possibility of exiting the UK tax system based on a split year treatment. Of course, that increases some sort of administrative work, but it also gives you a chance to take control of your tax situation much earlier than you would expect it to be. So, yeah, in this video, we are going to discuss split year tax treatment. How does that affect you as someone who is moving out of the UK and becoming a non-tax resident? And what are the implications of it? Today, we are joined by Laura Sant, who's a partner at LSR Partners. And we are going to discuss this more in detail with her. Laura, thank you for joining us today.
Thanks, Shiraz. So, in the UK, we use something called the Statutory Residence Test to determine an individual's UK tax residence position. And the starting point is that we look at the whole year. So, if we are looking at an individual who is leaving the UK during a tax year, the starting point is they are, if they're leaving maybe kind of May, June onwards, the likelihood is they are going to be a UK tax resident as a starting point. If they are leaving the UK and are going to be breaking UK tax residence, so effectively the following tax year they would be considered a UK tax non-resident, then what we can do in the UK is to look at something called split year treatment, which effectively splits the tax year into two parts, whereby, yes, the starting point is your UK tax resident for the year. However, from a particular date, you would be considered non-resident thereafter. And that's what split year treatment aims to do, is to split the year into a part whereby you're treated as a resident and part where you're treated as a non-resident.
Thank you. And then what would you say could be the effects of a split year treatment for a UK resident who plans to split their year between being a UK tax resident half a year and then a UK non-tax resident for the remaining half?
So the starting point, if you are considered to be a UK tax resident, is that you're subject to tax on your worldwide income. Obviously, there are various reasons why there may be some reliefs available to you if you're maybe not domiciled in the UK based on current legislation, or if you're treaty resident in another country. However, the starting point is you're taxable on your worldwide income. If you are a UK tax non-resident, you're taxable only on your UK sources of income. So why that might be important is, say, for example, you were to leave the UK midway through the year and start working outside of the UK midway through the year. By breaking UK tax residence, what that would do is it would potentially take the work that you're doing outside of the UK, outside the scope of UK taxation, and also if you had things going on outside of the UK, or income outside of the UK. As a starting point, subject to anti-avoidance rules, it would take that outside the scope of UK taxation as well if it were to happen in the overseas part of the year.
Sure. And then what would you say are the criterias for an individual to meet these split year tax treatment?
So there are three cases by which you can split the tax year on the way out of the UK. The starting point to think about it is, in terms of leaving the UK, you should be considered a UK tax resident in the year prior to the split. You should be considered UK tax resident in the year of departure up until the date of the split, and you should be considered non-resident in the tax year after departure. So it means that from whenever you leave the UK and break residence, you effectively have to be out for the remainder of the current tax year and the whole of the following tax year to be able to break residence. Now, in terms of the three cases, case one is starting full-time work outside of the UK. Case two is being the partner of somebody starting full-time work outside of the UK. And case three is ceasing to have a home in the UK. I'll go through those in a bit more detail in a second. But just to clarify that in terms of the order of priority, if you have multiple cases applicable to you, case one would take priority over case two, which takes priority over case three. So effectively, if you're leaving the UK to work outside of the UK, that's likely to be when the split would happen. With case one, where you're starting full-time work outside of the UK, effectively, you have to meet the criteria of full-time work outside of the UK from your first overseas work day through to the end of the following tax year. So your being non-resident the year after you leave the UK has to also be by full-time work outside of the UK. Now, the criteria for full-time work outside of the UK is that you must work an average of 35 hours per week, with no significant breaks from overseas work, which is where 31 or more days go by, and not one of them is either an overseas work day or would have been an overseas work day, but for annual leave, parenting leave, or sick leave. You mustn't be an international transportation worker with 6 or more journeys to or from the UK during a particular tax year. And then we have the day counts. So for a complete tax year, you must spend fewer than 30 work days in the UK during the tax year. And a work day from HMRC's perspective is where you work on at least 3 hours during the day. So, for example, if you were on holiday and just checking your emails, that's not likely to constitute a work day. But if you were coming into UK for the purpose of work, you're likely to have a work day in the UK. And then no more than 90 midnights during a whole tax year. For the split year portion, it's going to depend on the date on which the split happens. And as I say, the split would happen on your first work day outside of the UK. So if we go with, I say, an easy one, but effectively if the split year happens in October, the 30 work days as it's 6 months through the year would be reduced to 15 work days. The 90 midnights would be reduced to 45 midnights. And as I say, realistically, if you're looking at split year treatment, you probably want to be running it past a specialist just to kind of make sure that you're comfortable with those day counts. So that's case one. Case two is being the partner of somebody starting full-time work outside of the UK. So the idea is your partner is going to be leaving to work outside of the UK, and they have to effectively meet case one, either the year that you're relocating or the year before. In terms of your own position, the split would happen on the later of the date that either your partner meets the criteria for case one or the date that you are moving out to join them. So sometimes, I mean, I'm sure you come across it, Shiraz, where you get maybe one of the kind of couples who will go out, relocate in advance of their spouse, civil partner, common law equivalent, and the partner will join at a later date. So in terms of that, you'd be looking at basically moving your home or your main home to the country outside of the UK. And in terms of day counts, we would be looking at 90 days pro rata. So again, if you were relocating in August, if you were kind of meeting case two, you'd have up to 45 midnights to spend in the UK between then and the end of the year. So that's case two. And then case three is ceasing to have a home in the UK. So it would happen on the date that you cease to have a home in the UK, kind of the day thereafter. There's a couple of things with this one. The first is it doesn't matter when in the year this happens. You have a maximum of 15 midnights that you can spend back in the UK from this date to the end of the tax year. The second criteria is that we're looking at a 6-month test and basically settling in another country 6 months down the line. So if, for example, you were planning on leaving the UK and you were planning on travelling, you may find that you struggle with this test unless you're planning on travelling for a short period of time and then settling in another country. So within 6 months of having left the UK, you need to either have your only home or all homes in the country in which you're relocating to, or you need to be considered tax resident in that country, or you need to have spent every single midnight there for basically 6 months in order for this split year treatment to apply.
Well, thank you, Laura, for breaking down that for us. And kind of my next question would be in terms of the reporting requirements or obligations that a person would have when they're considering this split year tax treatment. So, when is the person required to report to the HMRC that they have become the non resident? And then, would there be two sets of filings, one being a tax resident and one being a non tax resident? How will the income get divided between these two portions of taxation? So, yeah, can you give us some overview on that?
Okay, so in terms of reporting it, if you're not within the self-assessment tax return system and you don't need to be within a tax return system, you can notify HMRC that you're leaving and effectively splitting the year using a P85 form. If you are within the self-assessment system and you're doing tax returns, you would only need to file one tax return. You would declare the split year treatment on the residency pages. Now you have to go careful because you can't look at, um, you can't file a split year return through a government gateway account. So you can't, if you're doing your own tax return, you won't be able to do it that way. You would either have to look at filing a paper return. Which would move the deadline for filing the return to an earlier date. You would need to use HMRC approved software, or alternatively, you would need to use an accountant to do it. And the reality is, split year treatment isn't the most straightforward. So, in the majority of instances, I would be suggesting you use an accountant to make that report to HMRC.
Sure. So on that note, like I understand um, a straight year treatment where your year end is the time when you're exiting the country system is comparatively and administratively much simpler than a split year treatment where you need an expert accountant to do that for you. Um, but would you say like one is better over the other? Like if your year has gone by and you have 11 months until your next year end, does this make sense to work with a professional and go for the split year treatment, or it's just you wait and then let the year pass? Given that the 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 viewership that we have on this channel is mostly business owners who are making a good amount of profits, and that will accumulate in the next 11 months, and that will get into the tax bracket for that tax year if they continue to wait for the full year tax treatment.
So if you were looking at people who are business owners and if they are extracting money from a UK limited company, the thing to be aware of as a starting point, as a UK tax resident for that particular tax year, the starting point is that if you were to take dividends from the limited company, then they're going to be taxable in the UK. Now, depending on which country you're going to and the double tax treaty, and assuming that you were becoming a tax resident in the other country, quite often there are agreements between the UK and the other country that might allow some treaty relief. Quite often we see in double tax treaties that dividends may be taxable at 10%, or the UK has the right to tax it at maybe 10%, maybe 15%. Occasionally they can tax the full amounts. But there's potential relief in terms of that for kind of from a treaty perspective. If you file a tax return and are taking dividends from a UK limited company when you're a UK tax non-resident, so full year non-resident, then there are potentially kind of some domestic reliefs available to you. So once again, if you are a limited company owner, probably having a conversation and understanding kind of the potential timing benefits for delaying some of those distributions might be sensible. Similarly, but kind of I say oppositely, if you have a UK limited company and you're planning on relocating outside of the UK and are going to be shutting up your UK limited company because effectively you do plan on living outside of the UK for a number of years, and commercially there's no reason really to keep the UK limited company open. So for business owners who may be looking at dividends or taking dividends from their limited company, I think the starting point is if you have a UK limited company and you're taking dividends from that would be considered to be a UK source of income, and therefore the starting point is it would remain taxable in the UK. Now, in the split year, or in a year where split year treatment applies, the starting point is that you're a UK tax resident. And what that would mean is that as a starting point, the dividends are taxable. Now, if you're relocating to a country with which the UK has a double tax treaty, we might be able to look at what the double tax treaty says in terms of what the rates of taxation should be. Quite often, for example, if you're treaty resident in another country, you may have a limitation, or the UK may have a limit to tax to tax the dividends at maybe like 10% or 15%. But effectively, we would need to claim treaty relief in order to limit the rate of tax on those dividends. If the dividends were instead extracted at the point when UK tax non-resident, subject to anti-avoidance rules, then those dividends has potential to be disregarded and therefore potentially no tax on those dividends. Kind of conversely, if you were to break UK tax residence and your intention is to leave the UK for a long period of time, at least 5 years, there's no real commercial reason to keep your UK limited company open for whilst you're a UK non-resident and effectively generating income outside of the UK, then you may decide instead to liquidate the company and take a capital distribution. Now potentially with that one, if you're a UK tax non-resident, from the date that you become a UK tax non-resident, basically those gains would not kind of crystallise as a non-resident, and therefore even if that were to happen during a split, like an overseas part of a split year treatment, there shouldn't be any UK tax implications, subject to not being temporary non-resident.
That makes sense. Yeah, so I think my final question is about what are some of the misconceptions that you see in your case of work when you're dealing with clients and that come up with these questions of split year treatment or straight year treatment? What are some of the misconceptions around it?
So to start off with, I think firstly, there's a misconception that like a lot of people don't even necessarily know that split year treatment applies. And as you mentioned at the start, a lot of people seem to think that they have to relocate bang on the 6th of April or the 5th of April. Otherwise they are, UK resident or UK non-resident. There's a lack of awareness about split year treatment. Secondly, you get people who say, well, I'm relocating outside of the UK, so I'm becoming non-resident, but don't actually meet the criteria or have no plans to meet the criteria of any of the split year treatment cases. So we do come across quite often people who maybe think they are breaking residence when in reality they are not. And if you're not breaking residence by means of split year treatment, you then do have to look to the double tax treaty of the country in which you're going to, assuming that there is one. Finally, quite a big misconception that we have is people where split year treatment does apply and they kind of go, oh, I don't want to declare it. I just want to pay tax as a UK resident this period. And that's not the case either. Like from HMRC's perspective, if split year treatment is available to you, you should be declaring that position on your tax return. Quite often people who want to do that, it would be because the tax position is more favourable in the UK than in the other country. So I'd say those are the big ones, really.
Okay. Thank you, Laura, for your time today.
Not a problem. Thanks for having me.
Sure. I think that's the end of today's session. And if anyone who is looking to move out of the UK or move into Dubai, United Arab Emirates, they can get in touch with me or with Laura. The links would be in the description below. And that's it for today's video, and we'll see you in the next one.